You're listening to international investment advisor Doug Goldstein on the Goldstein on Gelt show, the financial show where we'll talk about how you can make the most of your money. With all the confusing financial chatter bombarding you each and every day, Goldstein on Gelt will give you the practical information you want and need about living a financially stable life. Here's your host, money maven Doug Goldstein.
Okay, we are back. We are talking to Stephen Baffico, who is the Senior Managing Director at Claymore Securities. Steve is a frequent contributor to the financial media. He's regularly quoted in the New York Times, the Wall Street Journal, Barron's, Fortune, Financial Times, Bloomberg, Dow Jones, Reuters, CBS Market Watch, and more. He's also on the television and radio, including CBS Radio, CNBC, Bloomberg Television, Fox Business News, ABC, and others. Steve, it is a real pleasure to have you with us today.
Doug, thanks so much for having me. It is a pleasure to be with you.
So let me just start, since Claymore is very involved in the ETF world, the exchange-traded fund world. Maybe you could explain what are ETFs and what makes them different from regular mutual funds, regular open-end mutual funds.
Sure. No, it's a great question. I mean, there are certainly some similarities between exchange-traded funds and mutual funds, but probably more differences than similarities. I mean, I think in basic structure or composition, from the perspective of similarities, ETFs and mutual funds do share some commonality. Both are operate under their registered funds, meaning they operate under the guidelines set forth by the Investment Company Act of 1940. So basic structural things like the scope of eligible assets, some of the composition features, regulatory elements, oversight from a governance standpoint, and transparency and financial reporting, which the 40 Act requires. That, Doug, is by and large where the similarities end. I mean, exchange-traded funds have really exploded in popularity over the last decade or so, really reaching a peak of about $1 trillion in assets into 2007, today representing a universe of about $800 billion. Exchange-traded funds, as the name would infer, generally trade on a major stock exchange like the New York Stock Exchange, and liquidity is essentially determined through buying and selling on that exchange. It's different, of course, from an open mutual fund, which is purchased or redeemed directly with the investment company. So, there are a lot of different kind of nuances that exchange-traded funds provide, and primarily their ease of use and liquidity, daily pricing, and really access to markets, which have traditionally been a little bit more difficult to get exposure to, certainly have contributed to their popularity.
Okay, so exchange-traded funds, when you said that they trade daily, really, because they trade on an exchange, they trade all day when the stock market's open, unlike open-end mutual funds where people just get one price, which is the end-of-the-day price. So people like that kind of liquidity.
That's right. I mean, that's one of the chief advantages, or certainly differentiating characteristics, is the intraday pricing that ETFs offer. Many ETFs are repriced anywhere between 15 seconds and 15 minutes, just depending on the asset class and the structure of the portfolio. So you do get the benefit of really kind of fluid, active, real-time pricing versus a mutual fund, to your point, which typically prices once daily. So in many ways, it can be construed as a bit more real-time valuation of a particular sector that you're looking to equitize or get exposure to in your portfolio.
Okay, so let's talk a little bit about bond ETFs, and specifically Claymore recently came out with a new series of bullet ETFs. Could you explain why people would use an exchange-traded fund, an ETF, to buy bonds instead of, let's say, buying the bonds directly? And what are these bullet ETFs?
Sure. Again, a great question. I mean, I think that one of the chief benefits of utilizing an exchange-traded fund in the case of fixed income, particularly in the case of spread products. So that is to say, when an investor is looking to gain exposure to assets in the fixed income universe, which are those other than essentially government assets or all other assets which trade at a spread to Treasury, hence the name spread assets, something like corporate bonds, it is fairly difficult for an individual investor to create a diversified portfolio across a number of different credits, so by name, by duration, by individual credit quality. There are price, size, execution barriers that make it a little bit more difficult for the individual investor to build a well-diversified, deep portfolio in a fixed income product. So one of the chief benefits that an exchange-traded fund may offer is that exposure to a large pool of assets represented by an index which the ETF will generally track. So diversification, ease of use, liquidity, and certainly transparency in the pricing and ease of execution are all positive benefits of utilizing an ETF to express a fixed income idea in the portfolio. Now, bullet shares takes that idea, we hope and believe, a step further, Doug. Essentially what bullet shares are baskets of or indexes which create or represent baskets of corporate bonds, but which give you, as the individual investor, via their finite maturity, i.e., the term bullet, the opportunity to ladder maturity. So the concept of laddering bonds is not an unfamiliar one to many investors, where you're staggering maturities in order to either manage duration, express a particular kind of interest rate theme or curve trade, or even just kind of set up cash flows in a diversified manner, which allow you to allocate capital for future life events. Bullet shares really is the first ETF which replicates this in an exchange-traded format, in the sense that these are pools of corporate bonds with similar maturities ranging from 1 to 10 years, which offer you all the benefits that an exchange-traded fund or a mutual fund would in the diversification, that we were talking about earlier, execution, transparency, etc., but as well provide you the benefits that individual bonds do. Again, precision execution in the sense that they have finite maturities, so that you can build a customized portfolio around income needs, future life events, as I said, perhaps duration or interest rates concerns in a portfolio, and it's really an ease of use and customized approach that the bullet shares offer.
I see. We are talking to Steve Baffico, who is the Senior Managing Director at Claymore Securities. And Claymore recently came out with a new type of ETF, as Steve was describing, a bullet ETF. So one of the benefits that people like when they buy a corporate bond is they know it has a specific maturity date. On such and such a date, I'm going to get back my money. Of course, the guarantee of that is only as good as the guarantor, meaning if the company that issued the bond defaults, well, then you're not going to get your money back. But a lot of times people will like knowing that there's a specific date. How does that relate? Is there a similar guarantee with the bullet shares?
It's a great question in the sense that while there's not a guarantee of a return of par value, it really depends on where you're buying it at the front end of it. The fund, and each fund has a finite maturity, as mentioned earlier. Each of the current bullet share suite, ranging from 2011 out to currently 2018 in maturity, all have a stated termination date. Generally, that's at the end of the year, Doug. And so with each vintage or each bullet, as that product comes closer to maturity, and generally it's at the end of the year, at the stated maturity date, the fund will fully liquidate and return principal back to investors at the last published net asset value. So in essence, what's happening are that the bonds underneath that ETF or in the index, which compose that particular year's index, are maturing at various points throughout the year. When that occurs, those proceeds are escrowed in kind of a cash plus type of escrow account. And then, as I said, as the total portfolio matures and liquidates, that ending value, whatever that ending NAV, will be returned to investors at the stated liquidation date.
I see. And this stated liquidation date, the end is usually like December 31st of a specific year?
Exactly. It generally coincides with the end of the calendar year, just as many individual corporate bonds also have stated termination dates that run in a similar life cycle.
So it sounds as if the client is now getting, instead of owning one bond and hoping that the bond doesn't default, he'll own a package of, how many different bonds would typically be in one of these ETFs?
Sure. The bullet shares really seek to offer the diversification benefits of a mutual fund, as we're talking about. So the exposure to multiple bonds, and as we know in the post-credit crisis era, security selection or credit analysis on individual bonds or even equities becomes really, really critical. So it's much harder to create diversification and understand credit risk. So that have the benefit of an index that the bullet shares are constructed from, and we partner with Accretive Asset Management. Generally speaking, Doug, each of the indices, which represent years 1 through 8, are composed of anywhere between 90 and 140 bonds, which represent the character of that particular corporate vintage. So whatever the sector allocations and or kind of coupon yield, etc. Accretive has done a great job in constructing indices which are well diversified and very good proxies for the corporate market. The individual ETF will own anywhere between 30 and 45 of those bonds in replicating that index within the structure of the fund.
So if one of those bonds were to default, 1/30th, let's say, let's just assume it completely defaulted and went out of business, that would be 1/30th of your money would be gone.
That's correct.
But the benefit, obviously, is that it's only 1/30th instead of all of it had you bought, let's say, an individual corporate bond from one issuer.
Sure. I mean, you can compare that to an individual investor attempting to construct a corporate bond portfolio in their own portfolio. Tough to do that in smaller lot sizes to create the diversification and the kind of the size and execution and price on an individual basis versus doing so in a pooled vehicle like a bullet shares. Here, of course, you have the benefit of the finite maturity like an individual bond has as well.
I see. Okay, we are talking with Steve Baffico, who is the Senior Managing Director at Claymore Securities. We've learned a lot today about ETFs and the bullet shares that you have created. Maybe you could just give people a sense of how they could learn a little bit more.
Sure, Doug. Hopefully this has been helpful. We've certainly enjoyed the time together. As I said, we do believe bullet shares is a really unique and revolutionary new exchange traded product, very consistent with Claymore's innovative approach to the ETF market. To learn more, you can certainly check us out at www.claymore.com and /ETFs. That's claymore.com/ETFs.
Okay, Steve Baffico, thank you very much for your time.
Thank you.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.